Okay, welcome back from the afternoon break. It's generally agreed from a policy perspective that an effective system of international taxation is one that is consistent with the concept of tax neutrality. That is, the system should strive to be neutral so that decisions are made on the basis of their economic merits and not based on tax reasons. Most would agree that the current U.S. international tax system is riddled with many non-neutralities. Redesigning the U.S. international tax system in a way that will be consistent with the concept of economic neutrality is the subject of our next presentation by Alan Viard. Alan is a resident scholar at the American Enterprise Institute, where he studies federal tax and budget policy. Alan is currently an adjunct professor at NYU Law School. Prior to joining the American Enterprise Institute, Alan was a senior economist at the Federal Reserve Bank. He has also been a visiting scholar at the U.S. Department of the Treasury's Office of Tax Analysis, a senior economist at the White House's Council of Economic Advisors, and a staff economist at the Joint Committee on Taxation of the U.S. Congress. Alan, over to you.
Thanks, Larry. Thank you all for attending today, and thank you for inviting me to speak. So as indicated, I'm going to try to discuss the concept of neutrality. I'll be doing this from an economic perspective, but I hope with a minimum of economic jargon. So you can let me know at the end of the session, I guess, how clear I was or was not in trying to present this economic perspective. So neutrality in the mind of an economist is synonymous with the idea of minimizing distortions. And so I have to start, I think, by defining what I mean by distortion. And there is an important choice to make at the very outset, which really shapes how you think about corporate tax policy or about any other topic that you might be analyzing. The question is, are you analyzing these issues from a national perspective or from a global perspective? And there's much could be said about this. We could devote a whole session or a couple sessions to that topic alone. I'm not going to obviously be able to do that. Instead, I'm simply going to state and very briefly defend my choice here, following the same principles that Dan Shaviro has mentioned in many of his writings. I do adopt a perspective of national well-being from the standpoint that we should choose a U.S. corporate tax system that advances United States well-being. Of course, that doesn't mean pursuing destructive policies that bring us into conflict with other countries and then feed back to cause harm to the United States. But it does mean that we ultimately seek the well-being of Americans. I think that's a perspective that's well accepted in other contexts. Nobody really blinks an eye, for example, about the fact that the Affordable Care Act is intended to provide health insurance to tens of millions of Americans who would otherwise lack health insurance, while doing absolutely nothing for the hundreds of millions or even billions of people elsewhere on this planet who are even in greater need of receiving health care. We all understand that U.S. policy is by and large aimed at the well-being of Americans, although we take some steps to try to combat world poverty and human rights violations. Our primary focus is at home. And so that's the perspective that I'll adopt here. So from a national perspective, a distortion exists whenever one activity bears heavier U.S. tax than another activity that has the same payoff to American society. Any of these distortions will introduce some change in behavior done for tax reasons that would reduce well-being in American society. But not all distortions are created equal. Some are more harmful than others. In general, a distortion is more harmful when the penalized activity is more tax sensitive. So in other words, it's harmful to penalize something that people would then readily change. But it's also more harmful if the activity is already taxed or if it's already undersupplied for some other reason. And this would apply to many forms of real activity, that if we're piling one distortion on top of pre-existing distortions, we're already starting from a harmful situation, and so it's more harmful to be imposing that new distortion. Well, all taxes carry some distortions with them. Certainly any tax system that tries to be cognizant of people's ability to pay will have distortions. And so the task is not to say, well, let's try to eliminate every distortion that exists, but try to find a tax system that's progressive and that minimizes distortions relative to the feasible alternatives. It's my view, and the view of most economists, that the corporate income tax fares rather poorly along this dimension, that the corporate income tax has more distortions than the typical tax, many of them quite arbitrary and quite capricious. So many of them would apply even if we had a closed economy, and I'm going to briefly mention those, but then devote the bulk of my remarks to the open economy that we actually live in, where those distortions remain but are accompanied by other, perhaps even more serious distortions. So in a closed economy, the corporate income tax would impose a penalty on C corporations relative to pass-through firms. It would impose a penalty on equity relative to debt. And it would impose a penalty on some types of capital relative to other types. The evidence shows that when you look at the tax rules that apply to different types of capital and then look at the economic depreciation rates on those types of capital, that some assets receive favoritism relative to others. Assets that receive special tax credits, of course, receive favoritism through that means, and so on. But my focus today will indeed be on the open economy distortions, of which there are several. That we have a penalty on repatriation. We have a penalty on the avoidance of foreign income taxes. We have a penalty on investing to earn profits in the United States and on the booking of profits in the United States. We also have a penalty on investing through U.S. chartered corporations rather than through foreign chartered corporations. So I think that as we look at different reforms to the corporate income tax system, we need to pay careful attention to whether we make these distortions bigger or smaller. There will often be trade-offs between them, although, as I'll argue, some of these distortions actually could be eliminated quite easily. Others might be a little more tricky. Actually, I do want to start with the low-hanging fruit, the repatriation penalty, which I think is one of the more senseless features of the current system. Now, I think the costs of this distortion are more modest than many people have estimated. There is a view, for example, that we have $2 trillion overseas, and that if the repatriation penalty didn't exist, that $2 trillion would be, or in the past would have been, devoted to real investment inside the United States. There's no evidence or logic to suggest that that's even remotely true. The level of real investment in the United States is probably little affected by the fact that this $2 trillion is unrepatriated. But what the penalty does mean is that corporations have to jump through hoops to move money around, that they have to engage in financial transactions different from what they otherwise would have to avoid doing something that would be classified as a repatriation. And that's just economically senseless because it doesn't advance any coherent policy goal. There's no reason why tax should be linked to this particular event that we denominate as repatriation. Dan Shaviro has argued, I think rightly, that it's an odd side effect of the realization doctrine, that we don't think that the U.S. parent has realized income until the repatriation occurs. There is good reason why we might use the realization doctrine, at least to some extent, in our individual income tax system, although I'll argue we ought to curtail its use later. But it certainly makes no sense to apply it here. So we really ought to eliminate the repatriation penalty. Now, that's actually quite easy to do, and we can do it without resolving some of the other contentious issues that arise in the corporate tax reform debate. In particular, the existence of this penalty is irrelevant to the choice between the so-called worldwide and the territorial system, because you can and should eliminate the penalty under either system. What we do, of course, is just that we would impose, for future overseas income, we would impose any tax that we want to apply to it when the income is earned, and then there would be no additional tax upon repatriation. And of course, that's the approach taken in the President's most recent proposals. And of course, a similar principle applies with respect to this $2 trillion pool of past unrepatriated earnings. We should impose whatever tax we want to impose on them today, and then the repatriation will be tax-free if and when it occurs. And of course, once again, the administration's proposals actually reflect that approach of putting a one-time tax on that pool of unrepatriated earnings. So we can really eliminate this penalty quite easily and remain agnostic, I think, about the choice between territorial and so-called worldwide taxation. Maybe we want a zero tax on overseas earnings, maybe we want a 35% tax, maybe we want a 10% tax, but the tax shouldn't be triggered to when repatriation occurs. Another penalty that's often overlooked, and once again I find myself citing Professor Shaviro, is, of course, the penalty on the avoidance of foreign income taxes. The foreign tax credit and the Subpart F regime both penalize the avoidance of foreign income taxes. Stated differently, they create an incentive for the subsidiaries of U.S. multinationals to pay additional foreign income taxes. From the standpoint of national well-being, this is not something that makes particular sense. We don't really want our companies abroad to be paying additional foreign income tax any more than we would want them to be paying higher costs than necessary for utility costs or supplies or raw materials or whatever. If foreign income taxes really are the same as other overseas costs, and from a first blush they are with respect to the national viewpoint, then they should be deducted like other expenses. They should not be credited. There is a caveat here, I think, that it is possible that curtailing the avoidance of foreign income taxes may help protect the U.S. tax base. And to the extent that that is true, that would justify providing some degree of disincentive for foreign tax avoidance. So you might, in fact, want to treat foreign income taxes more favorably than a mere deduction, although it's hard to imagine that the full-fledged credit we have today is optimal. Once again, I think that issue can be largely resolved apart from the issue to which I now turn, the debate between territorial system and the so-called worldwide system. This rather contentious issue gets a lot of discussion, and I think from an economic perspective, much of the discussion on both sides is misdirected. So the proponents of the so-called worldwide system will talk about keeping jobs in the United States and not giving companies an incentive to take jobs and investment overseas. Proponents of the territorial system will talk about the need for the United States to maintain its competitiveness. Well, from an economic perspective, these may not be the right ways to frame the issue. Jobs are really not the right metric. The overall employment in the economy is going to be determined by the labor supply that people provide and by the functioning of the labor market, not by whether we are discouraging certain companies from investing overseas or not. And from a competitive perspective, no country can or should have a comparative advantage in all sectors. And so what we really want to talk about, if we're going to use the term competitiveness at all, is competitiveness in particular sectors. And we will see that as a valid argument in a minute. In particular, one argument that's often made for the territorial system is that we clearly need to have it, people say, because we do have these $2 trillion of earnings overseas. Indeed, at a recent presentation I gave, an audience member during the Q&A said he was surprised that I hadn't spoken more effusively about the territorial system, even though I'm actually inclined to favor it, as I'll mention in a minute. But he was surprised I hadn't spoken more effusively about it because, after all, isn't that the solution to the $2 trillion of overseas earnings? Well, as previously explained, no, that issue can and should be resolved completely separately. So I'm going to try to suggest what I think this debate really is or should be about. And I'll begin with a statement about terminology. At the risk of being tiresome, perhaps, I keep referring to the so-called worldwide system and using the scare quotes in my slides. I do believe that the term is a misnomer. If we had a truly worldwide system, that would, of course, be a most splendid thing for the United States to have. If we were able and prepared to tax all income everyone in the world had earned, it would be hard to imagine a better tax base for the United States or for any country. I do think, of course, that would be quite impossible to implement for a whole host of reasons. And because the United States cannot tax the overseas income of foreign corporations. So clearly the so-called worldwide system is not that type of splendid system. It is instead something quite different. The worldwide system actually combines a territorial system because all firms are taxed on income that's deemed to be earned in the United States, and then layers on top of that a charter-based tax system where U.S. chartered firms are taxed on their overseas income as well as on their income inside the United States. And so what we really want to think about is whether introducing that overlay of charter-based taxation, or as some would call it, residence-based taxation, corporate residence-based taxation, whether that actually is a useful addition to the system or not. It's not really a worldwide system. So turning to just a 30,000-foot comparison of these systems, which will really be quite inadequate in terms of comparing how they actually work, but hopefully will be useful in fixing broad ideas. The pure territorial system would involve that regardless of charter, all corporations would be taxed only on U.S. income. Now, this would impose a high penalty for both foreign chartered and U.S. chartered firms on investing in the United States and on booking profits in the United States. And obviously that is one of the criticisms that's imposed against the territorial system, is that it does you give a strong incentive to try to have profits either earned or at least booked outside of United States borders. On the other hand, it does eliminate one of the distortions that I mentioned earlier, the penalty on investing through U.S. chartered corporations. In the pure system that I'm describing, that penalty would evaporate altogether, because corporate charter or other notions of corporate residence would simply not play any role in the tax system. Again, I'm speaking about a pure territorial system, not about the systems that we necessarily observe in different countries that are referred to as being territorial. Those will diverge to a greater or lesser extent from this pure version. Again, though, useful to fix ideas, I think. So now let me turn to the pure version of the so-called worldwide system. My definition of such a pure system is different, I think, from other people's, and so that may be something that will be discussed in the Q&A. I think that if you were trying to achieve in full the objectives from a national viewpoint that worldwide taxation can advance, that what you would do is, of course, you would have no deferral. That, I think, is a common definition, common component of what people think of when they're talking about the so-called worldwide system. But from the premise that foreign income should not be treated any more favorably than U.S. income for U.S. corporations, you would provide a deduction rather than a credit for foreign income taxes. So this really would be a pure system in the sense of saying that we are, for U.S. chartered companies, we're going to treat that foreign income the same as U.S. income. Today, we treat it more leniently in two respects. One is deferral, one is the foreign tax credit. So I would define a pure worldwide system as being a system where you eliminated both of those provisions. If you eliminate only deferral, I would view that as a partial movement towards a pure worldwide system. So this system, of course, puts a high penalty on investing through U.S. chartered corporations, that they are subject to tax on their overseas income, a tax that they would not pay if they were foreign chartered instead. On the other hand, it does reduce one of the other distortions. For U.S. chartered corporations, there would be no penalty on investing and booking profits in the United States. Those profits would be treated the same as if they had been invested and booked abroad. On the other hand, the penalty for investing and booking profits in the United States, of course, would still be in full force and effect for those corporations that are foreign chartered. It would be eliminated only for those that are U.S. chartered. Well, if these are pure systems, they're obviously different from what we have in the United States. They're actually different from what any country has, because all of the countries are hybrids between these two pure systems in one way or another. The deferral and the foreign tax credit both greatly reduce the U.S. tax on overseas income of U.S. parents. So what's the effect of those provisions? Well, just as if you had granted an explicit rate reduction to the overseas income, the deferral and the credit have the same kind of effects as any movement in the direction of territoriality would have. They reduce one penalty and increase another. So they reduce the penalty on being a U.S. chartered corporation, on investing through U.S. chartered corporations. But of course, at the same time, they increase the penalty on investing and booking profits in the United States for U.S. chartered corporations, because those profits, once earned and booked here, will not receive deferral and will not receive the foreign tax credit. So it is one way, deferral and foreign tax credit are one way, or I guess I should say two ways, to move towards a territorial system. But they're actually not very good ways to do that, because they create other penalties, which I discussed earlier. They create a penalty on repatriation, and they create a penalty on the avoidance of foreign income taxes. And so it would be better if we thought that we wanted to make a move of this magnitude towards a territorial system, to do it through an explicit rate reduction instead of doing it through these two particular provisions that just create their own set of problems. So I would argue that as a first point in thinking about this, we should try to move away from deferral and foreign tax credit and the problems that they generate, and instead just ask ourselves, what rate do we want to impose on the foreign income of U.S. chartered parents? Do we want to tax it at the same rate as U.S. source income, or at zero rate, or do we want to tax it somewhere in between? Well, I think this is a choice between two imperfect systems, and we may quite likely not want to go to either extreme. My own personal view, which is a prediction about the future and therefore could, of course, be wrong, is that the so-called worldwide system probably has a dim long-run outlook, and I do emphasize the term long run here. We know that the worldwide system puts a penalty on investing through U.S. chartered corporations. It therefore creates an incentive to do investment through foreign chartered corporations instead. And we can see that play out potentially through a variety of behavioral channels. It would encourage foreign acquisitions, including the particular subset of acquisitions that we refer to as inversions. It could encourage newly established corporations to be incorporated abroad instead of having their initial incorporation in the United States. It could encourage American savers and other savers to do their portfolio investment through foreign chartered corporations. And here is where competitiveness in a particular market comes into play. It also results in the competitiveness displacement of U.S. chartered firms that are competing with foreign chartered firms in overseas investment opportunities. So these are challenges that the so-called worldwide system has to confront. There are measures that can be taken to counteract them, of course, and some such measures have been taken. Others will be taken in the future. The question is how effective those countermeasures will be in the long run, and I'm inclined to think that they will ultimately fail. Anti-inversion rules are stopgap measures. They're stopgap measures by construction because they say that if you had a U.S. charter on a particular date back in 2003 or some other date, that we will continue to treat you as if you have a U.S. charter, even if you swap that for a foreign charter, unless, of course, you do it through certain types of transactions that we will choose to recognize. Well, by construction, then, you're trying to prop up the charter-based, the charter basis of taxation by simply saying we're going to look at the past charter instead of the current charter in some instances. And, I mean, by definition, looking at some past date cannot be a permanent solution to these challenges. For some time, economists, I think, have been puzzled and surprised that there were so few inversions taking place. We thought that there were large tax savings to be had for multinational companies from shedding their U.S. charters and acquiring foreign charters, and yet for many years, of course, very few corporations actually took advantage of that opportunity. That shoe finally did drop, and of course we saw a wave of inversions in recent years. The other thing that has long puzzled economists is why newly established corporations are not incorporated abroad instead of in the United States. The initial foreign incorporation would, of course, allow you to be outside the U.S. tax base on your foreign income from the get-go, and it would spare you from being tripped up by any anti-inversion rules because you never had a U.S. charter. Now, the evidence, I think, quite clearly shows that although there have been a few instances of initial foreign incorporation, that they're quite rare, and that so far corporations being established by Americans are generally being incorporated here in the United States, perhaps because the establishers of the company don't initially anticipate becoming a multinational with large overseas profits, because of course most of them will indeed do no such thing. A few of them will, and if they do, they'll probably regret having done their initial incorporation in the United States, but of course that it'll be too late for them at that point. I do wonder, I pose the question of whether initial foreign incorporation is going to be the next shoe to drop. So I think all of these things kind of dim the outlook for the so-called worldwide system. I think that charter location is going to become more tax sensitive, and so we know that makes it more distortionary to tax it, and that taxing it may ultimately become unviable. We could, of course, replace the charter-based definition of corporate residence with a different one, such as the place of management or control. It would be less tax sensitive, I think, and therefore would be a better definition in that respect, but it would also be more closely tied to real activity, and it would be more distortionary in that respect, that you would actually be more likely to drive real activities out of the United States if you were putting a heavy multi-billion-dollar tax in some cases on the privilege of having your management inside the United States. Nonetheless, that may be the step that we see next for the so-called worldwide system. But my view is that we probably will find ourselves moving in the direction of the territorial system. I don't think that we necessarily will do it or would want to do it in the short run. We would need to address questions of base erosion. There would be a transitional issue. We would want to put a one-time tax on those unrepatriated earnings. And it is a choice of one imperfect system over another. And I'll just close, since I just have a couple minutes left, by saying that there are a couple radically different approaches that could be used that would address virtually all of the distortions that I've mentioned, and that would be either shareholder taxation or consumption taxation. Eric Toder of the Urban Institute and I outlined a proposal in April, and you have a report in your binders, where we proposed eliminating the corporate income tax and taxing the American shareholders of publicly traded corporations on dividends and capital gains at ordinary rates on a mark-to-market basis. That would eliminate the penalty on investing through U.S. chartered corporations and the penalty on investing and booking profits in the United States, because none of those things would matter anymore. You'd only be looking at the residence of the shareholder, not at where the income was earned, not where it was booked, not where the corporation was chartered. It would also either eliminate or reduce the various closed economy distortions that I mentioned earlier. But it would pose a number of challenges. There would be a net revenue loss that would have to be made up through other means. There would be thorny transition issues. It would be a volatile tax base. It would be politically problematic for a number of reasons. To my mind, these are challenges we should confront and accept, but they certainly can't be ignored. A still more far-reaching approach would be to switch to consumption taxation, which would also eliminate the penalties that shareholder taxation eliminates, and it would also eliminate the penalty on saving for the future rather than consuming today. There's a number of ways to move towards consumption taxation. We could expand expensing. We could adopt a value-added tax alongside the income tax, which is likely to occur, I think, at some point in upcoming decades. Or we could completely replace the income tax system with a progressive consumption tax, which could be either a personal expenditure tax or a Bradford X tax. Needless to say, this type of sweeping change would involve a whole host of transition and design challenges, which again would have to be confronted. They cannot be ignored. In conclusion, I would say that in the near term, I think that Congress is likely to continue tweaking the odd hybrid that we have obtained between worldwide and territorial system. I think in the long run, or the medium run perhaps even, Congress probably will be forced to consider making a partial move, most likely not a complete move, towards shareholder taxation or consumption taxation, or both. Thank you. I'll take questions.
You mentioned during your remarks that economists were puzzled as to why inversions had not taken place before they started in the last couple of years.
Yes.
Has there been any analysis as to why that has been the case?
I've heard various explanations of, and I think there's others who are better equipped to address this than me. The question, in case anyone didn't hear it, is whether there's been any explanations for why it took so long for the wave of inversions to start occurring. I've heard partial explanations of companies giving up on tax reform being adopted and other things like that. But I think my own view is probably it's just more likely a question of inertia. There's been examples in the past of where corporations have and other taxpayers have only adopted tax saving strategies gradually. So I'd be inclined to put it into that category. But I think it's actually an excellent question. I wish I knew the answer.
On your slide where you talk about the dim long-run outlook for worldwide systems, you've indicated that perhaps the next wave is U.S. Resident people would be incorporating overseas as opposed to...
Possibly.
Yeah, but hasn't there been studies that foreigners are disinclined to register in the U.S. because of the U.S. system? I thought years ago there was some sort of study, they said the amount of companies from overseas incorporating or people starting initial corporations in the U.S. had declined because of the U.S. tax system.
That's interesting. I don't think I'm familiar with the specific study. I'd actually love to see it. That does make good sense to me. You would think that, foreigners who might, in the absence of tax considerations, give some thought to incorporating in the United States they might well be disinclined to incorporate here. It does seem at this point that Americans who are setting up companies, are still inclined to incorporate here at home. So I think it will be interesting, but if so, that could be the first bit of that shoe dropping. So we'll see.
I haven't read your paper, but have you done estimates of the welfare benefits of moving to a shareholder level mark-to-market system and eliminating the corporate income tax?
I'm sorry, I didn't hear the,
Have you done any estimates of the welfare benefits of moving to that?
sort of quantifying the benefits?
Yeah, because if you're going to advocate it, then you'd want to be able to support the.
Well, absolutely. I think Eric Toder and I are doing a follow-up project now to look at some of the implementation issues in it, and as part of that, we're also hoping to provide a more informed estimate of what the magnitude of the benefits might be. I do think that whether we quantify the gains or not, there's ample grounds for thinking that they're very substantial. They just have this whole range of distortions in terms of where corporations are being chartered, where profits are being earned, and where profits are being booked. Distortions of whether you're set up as a C corporation or a pass-through, whether using debt or equity. Eliminating this whole host of distortions, has to confer significant benefits. So we would hope to quantify those, but I think the case, in some sense, at a qualitative level, arguably is stronger than some particular numerical estimate that somebody could pick apart. But it would still be useful, of course, to try to provide an order of magnitude, and we do hope to do that.
Yeah, I'm curious, what are your thoughts, either academically or from a policy standpoint, on having a worldwide system where a company's worldwide profits would be apportioned based upon some income-producing activities like property, payroll, and sales, or some other type of income-producing assets?
Formulary apportionment is probably worth considering if we stay within the context of the current system, but of course it's no cure-all. It trades, again, some distortions for others. So on the one hand, you eliminate the distortions associated with where profits are being booked, but then, of course, you impose distortions on where those real activities are located, right? If I apportion based on, well, say on sales and property and wages, then you penalize locating those activities in the United States. Sales is superficially an attractive tax base if you could really attribute the income to where the final sales to consumers are taking place. That is something that would probably not be very tax sensitive. And so it would be appealing, I think, to try to attribute the profits there. As we know, however, that faces formidable challenges, that if a company is selling some type of intermediate input to another company, we cannot directly observe where the final consumer market is. And allocating the income based on the sales to the other corporation lends itself to innumerable forms of manipulation. Between those challenges and the difficulty of reconfiguring the international tax architecture to accommodate formulary apportionment, which obviously it has no room for at the moment, I think the near-term prospects for that are probably limited. In the longer run, if we choose to stay within the context of the current type of system, though, it may be something we will need to confront. Perhaps looking at its challenges will persuade us that we do need to think outside the box in terms of shareholder or consumption taxation.
You talk about the benefits of a certain system over another, but in terms of the benefits of the taxation system as a whole, I think you have to look to the benefits of combined activities like education, building infrastructure that need to support the economies of the world, of the U.S. So it seems to me that all this talk about the taxation doesn't take into account the benefits that are derived from the combined activity through governments or otherwise.
Okay, I guess I'm not quite sure what the question means. Obviously, if one of these systems could provide the funding for education infrastructure and the others couldn't, that would be a pretty strong argument in favor of the system that could provide the funding. But I mean, we can raise revenue through any of these systems for all of those pressing purposes. And so I think when we look at how to raise that revenue, we want to do it in a way that has as few distortions as possible while maintaining progressivity. The question of how beneficial those expenditures are by the government would certainly play a key role in deciding how much revenue we need to raise and in how we want to spend that revenue. But I don't think it would have much bearing, if any, on the question of how we raise that revenue, and in particular, which of these different systems we would choose to raise it.
Hi. You just slipped in that while retaining progressivity.
Yes.
I'm not sure everybody agrees with that, but how do you address that as between U.S. and foreign corporations, U.S. and foreign individuals? I mean, what's appropriate?
So I think that our ability to tax foreigners is limited. If we were a small, perfectly open economy, it would not actually be possible for the United States to impose any net tax on foreigners who engage in transactions with us. If they have unlimited opportunities to earn some fixed rate of return everywhere else in the world, and we were just a small part of the world, then no tax could ever actually lie on them. They would exit the United States and not pay the tax at all unless market forces adjusted so they could continue to earn that same rate of return here in the United States. If the latter happened, then it would have to be true that the burden had been shifted to the Americans with whom they were carrying out transactions. Now, the United States is not a small, perfectly open economy, so there is some ability to extract rents, as it were, from those foreigners who do invest here. I think that my view on this is that if it was administratively easy, we would extract what rents we could from foreigners, since their well-being, I think, is not part of our underlying objective function as a country. And then the tax burden on Americans, of course, would be distributed in a progressive manner, which can be done, of course, under all of these systems. Obviously, a worldwide system or a territorial system can be equally progressive in its taxation of American shareholders. The same can be true of a shareholder-based system, and the same can even be true of a consumption tax if you use a Bradford X tax or a personal expenditure tax rather than a regressive consumption tax like a sales tax or a value-added tax.
On your shareholder proposal, how would you handle the fact that so many shareholders in the United States are tax exempt?
So you'd have to decide what rate of tax is appropriate for the income of these organizations. Whatever rate you choose, it could be 0, it could be 35, it could be somewhere in between, neutrality would call for that rate to apply uniformly, regardless of whether the entity is earning interest income or is earning corporate equity income. Today, of course, we do tax the corporate equity income earned by these organizations indirectly by imposing corporate tax on the corporations whose stock they own. But we exempt the interest income of those organizations because we've decided that they should, in some sense, be exempt. If we move to a system that eliminates the corporate income tax, then I think we would want to apply a neutral tax rule to these organizations and tax them the same on their interest income as we tax them on their corporate equity income. We would make that tax transparent, and we would apply the tax directly to the entity itself. One reasonably appealing, if ad hoc, approach, I think, is to say we would impose a uniform tax at the entity level on the interest income and on the corporate equity income that they earn that would raise roughly the same amount of revenue as we're indirectly collecting from them today through the corporate income tax on the shares that they own. But depending on your view about these organizations and whether they deserve favorable tax treatment or not, you could, of course, argue for a higher tax rate or a lower tax rate. And I suppose you might want to apply that rate differently. You might want to have different rates to different types of tax-exempt entities. For example, you might want to distinguish, perhaps in either direction, between a tax-exempt entity such as Harvard and qualified retirement plans. But a whole range of options would be available. The premise would be, though, that there should be neutral, transparent taxation of the entity uniformly across its interest income and its corporate equity income that could be set at any rate from 0 to 35 or whatever. All right, thank you.
Thank you, Alan.
Thanks, Larry.
Alan, thank you very much. Well, we've talked a lot today about the worldwide with deferral taxing jurisdiction of the United States, and this combined with the high corporate tax rate has caused a lockout effect of cash parked overseas, causing severe economic inefficiencies. Some are of the view that a territorial system of taxation is the solution. Our next speaker, Roseanne Altschuler, will discuss the characteristics of a territorial tax system, and she's going to compare and contrast lessons learned from several other countries that have already gone down this path and implemented a territorial tax system. Professor Altshuler served as chair of the Department of Economics at Rutgers University from 2011 to 2014. She was an assistant professor at Columbia and has been a visiting professor at Princeton University and also at NYU School of Law. Roseanne currently is on the panel of economic advisors of the Congressional Budget Office. Roseanne has also been active in the policy world, serving as director of the Urban Brookings Tax Policy Center, senior economist to the 2005 President's Advisory Panel on Federal Tax Reform, and special advisor to the Joint Committee on Taxation. Professor Altshuler, over to you.
Great, so that's a timer. Okay, fantastic, so I don't need this. Okay, well, thank you for inviting me. It's a pleasure to be here. And as you can see from the slides, the title of my talk is What Can We Learn from Other Countries' Territorial Tax Systems? So I think it makes sense to step back a second, even though maybe you've seen this already today, and ask what makes a tax system territorial. Territorial systems exempt all or 95% of dividends resident multinational corporations receive from foreign affiliates from home country tax. Countries with these systems are often referred to as having dividend exemption systems. Why? This is because what they do is they remove home country tax liabilities on active foreign income by exempting dividend remittances from foreign affiliates to home country parents from tax. So for that reason, they're called dividend exemption. And what I'm going to be doing in this talk is going kind of sloppily back and forth between dividend exemption and territorial taxation. But I'm really talking about dividend exemption. Now, worldwide systems tax foreign source income of multinationals either as accrued or when repatriated. So by that definition, most countries, and in fact all of the G7 except the United States, are territorial. All but 6 other OECD countries have adopted dividend exemption systems. So the outliers besides the United States are Chile, Ireland, Mexico, Israel, Poland, and South Korea. So that's where we are. We really are an outlier. I believe that there is broad agreement that our current system is very complex and induces inefficient responses. And this is agreement among policymakers and among companies. Our system provides incentives for multinationals to invest in tangible and intangible capital in some locations instead of others, to engage in costly strategies to avoid US taxes on foreign dividends, to shift reported income from high to low tax locations by using inappropriate transfer pricing or prices or paying inadequate royalties. And further, their pressure, as you've already talked about this morning, exists to re-domicile, which is a really fancy word for saying moving out. And the pressure exists when the tax burden under US rules exceeds what could be achieved through a non-US parent structure. So whether or not you characterize all of these incentives as making our system a mess or not, and we're not going to vote on that now, there certainly are a lot of distortionary incentives in the system, and that's something that Alan was just talking about. So as a result, many in the US are calling for reform of our system and for reform of our system for taxing international income and support moving to a territorial tax system. What I'm talking about today is based on a paper that I did with Steve Shea of Harvard Law School and Eric Toder of the Urban Brookings Tax Policy Center. And we thought it would be a good idea to look at some countries that we thought we could learn from to see what we could glean from their dividend exemption systems, from their territorial tax systems. And so what we decided to do, we embarked on this project, and as projects go, this one took a while, like most of them do. It's more than a year of working on this, gathering people together, which I'll say something about in a second. And so what we decided to do was to look at 2 countries with long-standing dividend exemption systems, and that's Australia, and Germany. Australia, interestingly, they've always been have a territorial dividend exemption system, except in 87 through 1990, where they went to a worldwide system with deferral. So that's just interesting in itself, although we don't talk a lot about that in the paper. And Germany is long-standing territorial. Before 2001, however, dividend exemption was only implemented with treaty partners. So we looked at these two countries with long-standing dividend exemption systems, and then two countries that had just recently moved to dividend exemption systems, and that, as I'm sure you're aware of, those two countries are Japan and the United Kingdom. So it's very interesting to study. And then we compared, or we tried to compare or draw lessons for the United States. So what I've done on this slide is I've cited the paper. It's not in your package, but if you were to look at the paper, you'll see a cite to a companion paper that's actually a report from a full-day gathering of international tax experts at the Urban Institute. And I sat down and read it recently. I recently testified before the Senate Finance Committee on international tax. And it's a really interesting read, I have to say. Maybe it's I'm biased or I'm just a complete, total tax nerd, but I thought it was really neat to read what this group of people had said. We gave them some structured questions, and I highly recommend it. I don't have a cite for it. I just remembered that I should talk about it, but it's referenced in the paper that's referenced on the slide that you have in front of you in your book. So before getting started to talk about the lessons that we learned, we started by noting to ourselves that there's differences across these countries in more than just international tax systems. And so I thought it's important to put that on the table, or as I've done here, put it on a slide. And I'm not going to go through each of these numbers, just kind of draw some observations from this, and some of it's in the table, some of it's not. The US has the largest economy by far, and except for Japan, is actually the least exposed to international trade. Exports and imports accounted for a much smaller share of GDP than all of the others, and we're similar to Japan. The UK has the largest volume of outbound and inbound FDI relative to GDP. I didn't show it in the table here. They're very much exposed to international capital movements. The figures that we have here on the economic differences may have some implications for the different constraints that the 5 countries face in designing international tax policies. Well, what do I mean by this? Australia is a large capital importer. It's more concerned, therefore it's not surprising that it's more concerned about how it taxes corporate income from production in Australia and the portfolio income of foreign investors than rules for taxing foreign source income of Australian companies. The US is the largest economy, and it's the one least exposed to trade and capital movements. Therefore, we may have some ability to impose higher taxes than others on US source income of all corporations, and to a lesser extent on the foreign source income of US corporations. Japan is most similar to the US, but has had a stagnant economy and has a small amount of inward FDI. Therefore, it may need to focus on keeping rates low to encourage investment at home. And now, Germany and the UK, as you know, are both members of the EU, where there's very free movement, internal movement of capital and people. Therefore, they're highly exposed to trade and capital movements. So in designing tax policies, they have to pay particular attention to incentives created for investment location and headquarter location. The countries, I have a little bit on the bottom here, the countries have different business and industry characteristics. Australia has large natural resources. Germany and Japan have a relatively large share of value added in manufacturing. The US, UK, and Australia have relatively large share of value added in finance and insurance. Now, we also want to look at comparison of tax policies. And this is, when you look at the numbers, you may be a little confused by them. For instance, corporate tax rates. This is looking at national and subnational tax rates and revenues. So the US, who I'm sure you're familiar with the fact that we have low revenues relative to GDP compared to these other countries, compared to OECD countries. These countries differ substantially in their reliance on the corporate tax. The US has the highest combined rate, again, national and subnational. I think the Japan combined rate is now down to like 35%. And the US, Germany was a little bit surprising here, but looking at that last row, the US has the largest share of business profits from companies, has the lowest share of business profits from companies subject to the corporate tax. 60% of business income is in the non-corporate form now in the United States, so it's just going through flow-throughs. So that's just a little short tour of tax policies. And so with this background, Steve Shea, Eric Toder, and I examined the factors that drove policy choices in the 4 countries that we studied, and we put forward some lessons we believe the U.S. can take away from their experiences. And some of this you've already heard, but I think it's important to go through again. So the remainder of my talk, I'm going to go through what we learned, lessons that we learned. So the classification of tax systems as worldwide or territorial oversimplifies, and Alan talked about that a little this morning, earlier, right before me. And you may have talked about it this morning, but I was unable to be here. I had to be at a meeting at Rutgers. All systems are hybrids that tax some foreign business income at reduced effective rates when you take exceptions and anti-abuse rules into account. The distinctions are really not as sharp as the labels worldwide and territorial make them appear. So just as examples, Japan and the UK allowed multinationals under their worldwide systems to bring back foreign earnings through related party loans. Okay, that doesn't sound like a worldwide system to me. The US allows deferral and a liberal foreign tax credit. As a result, little tax is collected on dividend repatriations. So looking a little dividend exemption-y, if that's a word. Most territorial countries impose tax on foreign source income as accrued, on some foreign source income as accrued, in order to protect their domestic corporate tax base. So the classifications of tax systems as worldwide or territorial really does oversimplify. The other thing that we learned is that the circumstances that caused other countries to maintain or introduce territorial systems do not necessarily apply to the United States. Countries differed greatly in the extent to which they weighed conflicting policy concerns, such as the effects of a change in the corporate tax system on domestic investment, on residence decisions of multinationals, on profit shifting, on the burden of the repatriation of foreign profits, on the taxation of inbound investments. And countries also differed in the extent to which they took budgetary effects of the corporate tax policy changes into account. Policy decisions don't appear to have been based on an analysis of how foreign source income was effectively being taxed. We were very surprised by this. What I mean is that the changes that we saw in the UK and Japan don't seem to have been driven by analysis of administrative data. So to the extent that they were evidence-based, they seem to have been based on anecdotal evidence, and from what we could see, not based on a close look, a close analysis of administrative data. So that was a surprise to us. This is similar to what I just said, but the tax policies of countries with dividend exemption systems have been influenced by their separate circumstances. So as a net capital importing country, Australia's main goal for its corporate tax has been to collect taxes from foreign corporate investors. They're less concerned about outbound investment by Australian companies. Australia also has an interesting imputation system. It allows domestic shareholders to claim credit for domestic but not foreign corporate taxes paid by Australian companies. So this may actually reduce tax avoidance through shifting profits abroad, since Australian shareholders aren't going to get any credits if domestic tax hasn't been paid. So that's an interesting thing about the Australian system that I think some people find intriguing. In terms of Germany, they adopted dividend exemption years ago to foster foreign investment by their companies. Other EU countries also had dividend exemption systems that influenced German practice. So that's kind of the Germany story, I mean, for what I have time to talk about. Japan adopted dividend exemption in 2009 to make its companies more competitive and to encourage them to bring back accrued overseas profits. One of the things that we learned through the all-day conference that we had, that I'm telling you that you should read the entire transcript of that conference, one of the things that comes out is that Japan appears to have a compliant international tax planning culture. We were told, advisors told us that multinationals are not aggressive tax planners. So that would affect the decisions that they make. In fact, the government didn't seem to be concerned that income shifting would increase with dividend exemption, which is something that we're very concerned about in this country when we start talking about moving towards a dividend exemption system. Won't income shifting incentives go up? They didn't enact new anti-avoidance rules with the switch, and there was no transaction tax on repatriations of pre-effective date profits. The UK was mainly concerned with losing corporate headquarters when it adopted dividend exemption in 2009. The loss of headquarters is obviously facilitated by their proximity to countries with lower rates and territorial tax systems. So they lowered their corporate rate to 21% and introduced a patent box when they went territorial. They were less concerned about tax avoidance, and as I said before, had a system that was kind of equivalent or close to equivalent to exemption, since they could return borrowed funds to their shareholders without paying a dividend repatriation tax. This next one I think is very important, and I think Alan touched on it also. The burden of the tax due upon repatriation of foreign earnings may be a lot higher in the US than it was in the UK and Japan. The burden includes the actual tax paid upon repatriation and the implicit costs of keeping income abroad. So the implicit costs include, for example, the cost of using parent debt to finance domestic projects as a substitute for foreign profits, payments to tax planners, foregone domestic investment opportunities, and foreign acquisitions that may not have been undertaken in the absence of the tax. I've worked with Harry Grubert at the Treasury Department, Office of Tax Analysis, and we've done a estimate using data from the tax returns of multinational corporations of the implicit cost of the repatriation tax for a highly profitable company, and we find it to be about 5 to 7%. What is this? You can think about this as the amount a company would be willing to pay to have the repatriation tax on an extra dollar of foreign earnings removed. That's the implicit cost. And we're finding it to be 5 to 7%, which I think is significant. It's also higher than previous estimates that Harry Grubert has done and also we've done together. And what we see is that it increases this implicit cost of keeping income abroad increases as deferrals accumulate abroad because it becomes more and more costly, for instance, to borrow against them as you have more and more abroad. I'm not aware of any estimates of the burden of the repatriation tax in the UK and Japan before it went territorial, but I would think that the US repatriation tax burden is much higher because both Japan and the UK, again, as I've said many times, were effectively dividend exemption countries because they could return funds to the parent via subsidiary loans or investment in parent companies without having to pay a repatriation tax. Another thing that we learned, or we comment on, I think everybody knows, we raise relatively little corporate tax revenue as a share of GDP than other countries, while having the highest statutory rate in the OECD. But this fact has multiple explanations and doesn't suggest that US companies in any given industry are more aggressive at income shifting than foreign companies. I would say that we really don't know. I know that there are other studies out there that have used non-US data to look at income shifting of foreign companies. I'm not thrilled with the data sets that they have. What's going on? Well, we know a relatively large share of business activity in the US comes from firms that don't pay the corporate income tax. We also have corporate tax expenditures with special provisions and rates that reduce US corporate tax receipts. So the fact that we have little corporate tax revenue as a share of GDP while having a high rate doesn't necessarily mean that it's income shifting. We just don't have good information, and this is a problem that they're running into with the BEPS project. So that is another conclusion that we draw. So, or one of the lessons. So some conclusions from all of this. One of the things that, we kind of go both ways in this paper. We say you don't have to do what everybody else does, but we really are subject to the pressures that other countries have been subject to. So the US need not follow other tax policies. But we think it was really important to do this type of a study. The fact that we don't need to follow other tax policies doesn't mean that our reform process should be done in a vacuum or by a guy with a vacuum. After I put that on, I thought to myself, there should be a person in a vacuum, not vacuuming. But you never have enough time to think about everything. Territorial definition is not the whole story. The devil really is in the details. Better data exists on U.S. multinational income shifting than for other multinationals, for foreign multinationals. They may do as much as we do. We just don't know. And as I said before, I think this is a problem for the BEPS effort. I know that they put something out on this a week or so ago. I just haven't had a chance to look at it yet. I think that the U.S., our ability to retain high rates and tougher rules on foreign income is declining. We face the same pressures as countries that have lowered taxes and moved to dividend exemption. We face growing competition as an investment location. Our multinationals face growing competition from multinationals that are based in exemption countries. There are advantages of foreign residence. So the pressure exists that may force us to eventually abandon our tax exceptionalism. But the question of which way we go is not all that clear. And I think Alan brought that up a little bit. Maybe we'll abandon our tax exceptionalism by adopting a VAT and using that to lower the corporate rate, and the individual rate is something that we could do. That's another whole question, but you could use a VAT to lower corporate rates, and that just takes a lot of pressure off of the incentives that I talked to you about. So if you lower the rates, those incentives just aren't as strong. So I think that is it. That's it for what I had to say, and I guess we're going to open it up for questions. Thank you.
You mentioned at the end of your remarks that we don't have good information to compare across countries about the income shifting. Could you tell us a little bit about why we don't have that information and whether you think that there is a procedure that could be employed to get it?
So that's a great question. That's exactly what the BEPS project, what number is it? Is it 11 or 11? I got it, first try. 11 is all about, is trying to, so we have that Form 5471. So we have that information form. We have a Treasury Department that has for many years been able to do studies based on the information from tax returns. And it just doesn't seem that other countries have collected the same type of information that we've collected on our multinationals and have not made the same efforts to do the studies that we've done. For whatever reason, the data is just not out there. And so the data that's out there to do the types of studies that economists are doing are data from maybe publicly available sources, which has some pluses and has some minuses. Really, I think that the Treasury, the tax return data is where the action is where we can learn the most. And until the UK, I mean, maybe they have a lot of stuff, but they certainly don't have a Harry Grubert that's doing these types of studies and putting them out. But they certainly, you just are not seeing papers out there that are using administrative data. And even just the SOI data that you can use, that you can download yourself. I mean, I can tell you 10 reasons why, there's problems with that data, but at least it exists, okay? So, yes.
Yeah, I have sort of three related questions with respect to countries that have adopted, let's call them pure territorial systems, as pure as you can imagine. I don't know which countries those are, but maybe Germany, I have no idea. Three questions. One, does the system extend to portfolio income of companies? Two, do those countries do anything about domestic deductions associated with the exempt foreign income? And three, what do those countries do about foreign royalties paid from abroad received at home?
Okay, you know the answer to all those
No, I
questions.
don't. I really don't. And I think it's assumed, and it has actually been stated here today in a couple of the panels, that territorial would mean non-taxing of foreign income. That's simply
No,
not
that's
true.
okay. That's simply false. So I believe that all of the countries that are territorial tax portfolio income. To go back to David, so I believe that they're all of what we would call, they all have something like subpart F income.
So they
that
need a definition of corporate residence for that purpose, correct? So
I would think that they would, yes.
Yes, okay,
Yes,
thank you.
yes. In terms of allocation rules for like interest, they don't. They don't, very few.
Do they disallow any deductions associated with foreign income?
Not, I mean, I know about interest, not that I know of. But again, somebody correct me if I'm wrong. I don't think so. And then your third question, which I knew the answer
Royalty
to.
income. Royalty income
Royalty
earned from
income.
abroad.
Okay, so royalty income, there's a lot of patent boxes out there. There's a lot of favorable treatment out there.
No, but I'm talking about
Oh.
royalty income
Oh,
paid from abroad and earned in the home country, received by a home
Right.
country recipient.
Doesn't
there are
France?
patent boxes.
It's patent boxes. I'm thinking about patent boxes. I think France has a lower rate on royalty
But
income.
that's independent of territoriality.
That's independent on territoriality. Yeah, it doesn't have to be. Right, right. And in fact, one of the big differences between our current system and a dividend exemption system, any dividend, if we were to go, let me start over again. If we were to go to a territorial system, there would be a very big difference in how royalties are taxed, because under the current system, firms are using excess credits to shelter taxes that would be due in the US on royalties. Under a dividend exemption system, a royalty is not a dividend, it's a royalty. It would be taxed as kind of US source income at the US rate. And so then there's a question, so that would be a very different treatment of royalties. In fact, that's why you can actually raise revenue by going to a dividend exemption system. Of course, the devil is in the details. So I hope I answered your questions, yeah. And nobody's protesting, so that's good. Great. Thank you. Thank you. Wait a minute. Thank you very much.
Thank you, Professor Altshuler. Our final panel today will explore the various U.S. international tax reform legislative proposals that have been put forth, compare and contrast them, and suggest prospects for the future. Our distinguished panel includes representatives from KPMG's Washington National Tax Office, including Manal Corwin, Thomas Stout, and Robert Wilkerson. Manal leads KPMG's international tax practice and is the principal in charge of Washington National Tax, international tax policy. Prior to rejoining KPMG, Manal was the Deputy Assistant Secretary of Tax Policy, International Tax Affairs in the United States Treasury Department. Tom Stout is KPMG's Director of Federal Tax Legislative and Regulatory Services based in Washington. Tom is past chairman of the AICPA Committee on Tax Policy and Legislation and holds a graduate tax law degree from Georgetown University School of Law. And Bob Wilkerson is an international tax principal in KPMG's Washington National Tax Practice. Bob is a frequent speaker on international tax matters. Bob earned his tax LLM at NYU Law School. So welcome back, Bob. And I'll introduce the panel to the stage. Thank you.
right, so the home stretch panel. I'm impressed, it's still a fairly full audience. So good afternoon, everyone. So our charge this afternoon is to go through in a little bit more detail the international tax proposals that have been made so far. And I think they've been alluded to numerous times in almost every panel, but we'll delve a little bit deeper into the question or into the proposals that are out there. The conference started with the question of, is our international tax system broken? And I think that if you listen to what we've heard today, and certainly the subject has been the debate, or has been debated over the last 20 years, the emerging consensus is that, in fact, our international tax system is sorely in need of reform. And where we are today is that we have a number of proposals now coming not only from the administration, but from both sides of the aisle in Congress, as well as the business community, that are converging around a sense that we do need to reform the international tax system. The reform proposals, interestingly enough, while very different, and actually let's talk about what we've got, and we're going to focus on two, but in terms of the proposals that we've seen most recently that address aspects of our international tax system, they include former Senate Finance Committee Chairman Baucus's framework for international tax reform, former Ways and Means Committee Chairman Camp, who put out a very comprehensive, probably the most comprehensive that we've seen, international tax reform proposal, broader than international, obviously, but certainly comprehensively covering the international tax rules. The President's framework on international tax reform in 2012, followed by this budget, just the FY16 budget that we just saw that picked up on that reform framework and provided more detail. And then we've also seen now Senate Finance Committee Chairman Hatch, current Senate Finance Committee Chairman Hatch, issue a report about the need for comprehensive tax reform. And then in terms of initiatives, we've also now seen Senate Finance Committee Chairman Hatch and Ranking Member Wyden put together a five bipartisan working groups to focus on the need for reform, and international is one of those working groups. So that's a shift too, in that we haven't for a while seen bipartisan working groups focusing on an issue. So that's a significant development. One of the things that you see as you go through these proposals, while certainly they have many, many differences in terms of the approach and the technique to addressing international tax reform, they actually have quite a fair amount of common ground, particularly in the international area. I think they all converge around the need for reform. We've talked about that. All of the proposals that are out there converge around the need to reduce the corporate income tax rate and broaden the base. There are differences in how low that rate can go, and those differences are more related to what can you pay for than so much a policy view as to what the exact right corporate income tax rate, but a consensus around the need to lower that rate. They all also converge around the need now to eliminate the tax on repatriated earnings. So our worldwide system with deferral has this lockout effect that's been spoken about quite frequently, that forces taxation upon repatriation. And the proposals that are out there right now eliminate that. So there's no longer a tax on repatriation. They all have recognized that active offshore earnings ought to be subject to a lower rate of tax than domestic earnings. Again, the approach to and how much the lower tax ought to be is different, and the definition of active earnings is different, but structurally there is a consensus around a lower tax on active offshore earnings, or an exemption in certain cases. And then finally, all of the proposals that are out there have a component or recognize the need to do something about base erosion, express concerns about base erosion and mobile income, and address that through a number of provisions that are common, including widening, in certain cases, the CFC rules, Subpart F rules, denying deductions in certain cases with respect to outbound payments or earning stripping concerns, and then limiting the deductibility on interest expense, like a cap. Again, we're seeing a commonality there. That's a fair amount of common ground in the world that we live in legislation, if you think about the international proposals. Again, technique is different in approach, but scaffolding and structurally fairly close in structure, with the debate really being about how wide each of the categories is. The other, I think, significant development that I alluded to earlier is the fact that you've now got these 5 bipartisan working groups formed. Again, it's been a while since we've seen, I think, effective bipartisan cooperation to at least look at the issues and study the issues. And so that's, I think, a significant development. The working groups have sought input from the business community and other stakeholders, and are expected to provide a report to Senate Finance Committee in May. So if you look at that, you say, okay, well, things are moving. You know, we've been talking about this for 20 years, but maybe we're moving in a direction where something's going to happen. And earlier, Deputy Assistant Secretary Mazur suggested that he's somewhat of an optimist about the possibility. I think a lot of people are still skeptical, but I think we are certainly at a stage where the development and the discussions that are happening now will form the basis of what ultimately does happen, whenever that is. So we want to, in today's panel, focus a little bit take a little deeper dive in the 2 proposals, or the two proposals that are out there, I think, forming the 2 sides, I would say, of the debate, to the extent there are 2 sides. So former Chairman Camp's comprehensive proposals for reform, and the administration's proposals for reform, and then turn to what truly are the prospects that we'll see change, and we'll see if Tom is as optimistic as
ever, as
Mark Mazur, right? So with that, let me turn it over to Bob to talk about Chairman Camp's proposals.
Okay, so what we're talking about now are proposals included in Chairman Camp's 2014 comprehensive tax reform draft. As many of you will remember, a couple of years prior to that, I believe it was in 2012, maybe earlier, but Chairman Camp had released an initial draft that was focused solely on international tax reform, and a territorial system was a key feature of that. The 2014 comprehensive draft includes the original proposals, but with modifications taking into account comments received after the initial draft was released. So what we're focused here on is just the international tax provisions from the comprehensive draft. And then, while not mentioned here, a key feature of the draft was a proposal to reduce the domestic corporate tax rate to 25%, and that plays into some of the specific provisions here. So the key feature of the draft was a proposal for a participation exemption in the form of a 95% dividends received deduction for dividends received by domestic corporate shareholders who are United States shareholders, so 10% shareholders, from certain 10% owned foreign corporations. This proposal would include not only dividends received from CFCs, but also dividends received from so-called 1050 companies. The 95% DRD means that 5% of the dividend is taxable, and the 5% taxable portion is intended to be a proxy for sort of disallowed expenses or expenses associated with generating that exempt income, rather than having a separate proposal to disallow expenses allocable to the dividend itself. And you'll see that's different from the administration's proposal in some respects.
Bob, it might be worth pointing out with respect to that 95% DRD, Manil mentioned at the beginning that the Finance Committee staff has produced a white paper on reform. And one of the things they discuss in there are studies that have indicated that if you really wanted to fully allocate expenses to foreign income under a participation exemption system, the percentage would be more like 70 or 75% rather than 95%.
Okay. in any event, it's 5% in this draft, and may be a bit ambitious.
And you know, and exemption systems abroad, 95 is a common number, and they do use the 5% as the surrogate for allocation of expense. So the study is sort of a counterpoint to whether that is sufficient.
That's right. And with all these things, you'll see, including sort of the rates, the rates that would apply, the rates that would apply to repatriation, et cetera. All of these things can be adjusted up or down to generate revenue or deal with revenue needs as well. So back to the proposal itself. Of course, if you're going to allow exemption, no foreign tax credit would be allowed for taxes attributable to dividends that qualify for the exemption. And the proposal includes a 6-month holding period requirement to be eligible for the DRD. Interestingly, the proposal includes no specific exemption for stock gains, so gains on the sale of CFC or 1050 company stock. There's no specific exemption for those, unlike Chairman Camp's initial draft released earlier. It appears that selling shareholders that recognize Section 1248 dividends from the sale of stock would be able to apply the 95% DRD to those deemed dividends under Section 1248, but otherwise no exemption for stock gains. Foreign branches are not subject to any special rules. In Chairman Camp's initial draft, he proposed to treat branches as corporations that would then qualify for the DRD. There were a lot of complications with that. He also had suggested that those branches would be deemed incorporated prior to being eligible for the DRD, which would result in deemed transactions, taxation, and the like. And so the 2014 draft just abandoned that approach, and branches are not subject to special rules that then qualify for the exemption. And there's some special rules that deal with limiting losses recognized with respect to stock that qualifies for the participation exemption. So another feature, as in his initial draft, was a proposal to tax existing deferred offshore earnings. And he would implement a new Section 965 like we had a few years ago that would subject any U.S. shareholder, so again, 10% shareholders, but not limited to 10% shareholders who are corporations even, but that own 10% of a foreign corporation to a deemed repatriation of the earnings, of the deferred earnings, untaxed earnings of that foreign corporation. A deduction would be allowed with respect to those dividends, and the amount of the deduction would vary depending on whether the earnings underlying the dividend were invested in cash offshore or instead were invested in operating assets and the like. Earnings invested in cash, dividends attributable to earnings invested in cash would qualify for a 75% DRD, whereas dividends attributable to earnings invested in operating assets and the like would qualify for a 90% DRD, so a more favorable rate for earnings invested offshore in active operations. The inclusion would be affected through our Subpart F rules, and a key provision is that the deferred E&P that's subject to this deemed repatriation would be determined by looking at all of the investments of a particular shareholder and allowing adjustments for E&P deficits of foreign corporations, 10% owned corporations. So a positive E&P in one subsidiary and a deficit in E&P in another subsidiary could be netted, in effect, for determining the amount of net E&P that's subject to repatriation. And then another key feature was an election to pay the tax on the deemed repatriated profits in installments over 8 years, and it's actually a favorable sort of schedule for paying that out that's more back-weighted so that more of the tax is payable in the later of the 8 years. So Professor Rosenblum asked 3 questions of the last speaker, and they're sort of all relevant to, because Chairman Camp's talking about going to a territorial system here. He's also focused on the 3 things that you raised questions on in his draft. If you're going to provide an exemption for offshore earnings, certain categories of earnings are not going to qualify for that exemption. And so his proposal is to retain our Subpart F rules as a basis for determining what qualifies and what doesn't, and makes a number of modifications to that, including modifications that are designed to ensure that certain types of earnings are subject to a sufficiently high foreign tax, so a minimum foreign tax in effect, as a marker for what qualifies for the exemption and what does not. So he has a new category of Subpart F income, foreign-based company intangible income. I'll come back to explaining what that is in just a few minutes, but it would be a new category of Subpart F income. Otherwise, retains the Subpart F rules with a couple of modifications we'll mention now. There's a mandatory high tax exception, so earnings that are subject to tax at a rate at least equal to the U.S. rate would be excluded from Subpart F. As sort of a starting point. Then also certain types of income, foreign-based company sales income in particular, would qualify for this high tax exception as well if they were subject to a rate of tax at least equal to 50% of the U.S. rate. So his proposal was for a 25% rate, so income, foreign-based company sales income taxed at a 12.5% rate would be excluded from Subpart F. I mentioned foreign-based company intangible income, which I'll describe in more detail in a minute, but the proposal would be that foreign-based company intangible income that's taxed at a rate at least equal to 60% of the U.S. rate would be accepted from Subpart F income as well. So then for foreign-based company sales income, if it does not qualify for this high tax exception of at least 50% of the U.S. rate, then the inclusion would be of 50% of the foreign-based company sales income, so 50% would be excluded. So effectively, the 50% of foreign-based company sales income taxable in the U.S. under our Subpart F rules at a 25% rate equates to a 12.5% overall rate on the foreign-based company sales income. A deemed paid credit would be allowed with respect to all of these categories of income. Section 960 would be preserved as part of this regime. Oh, and the last feature on the slide is a provision that would actually exclude from foreign-based company sales income earned by CFCs that are themselves qualified residents of a jurisdiction with which the U.S. has a comprehensive income tax treaty. So that's a new provision and something that would eliminate the high tax test for CFCs resident in countries that have a comprehensive treaty with the U.S. Active financing, these are the deferral rules that apply to banks and active financing companies, broker-dealers and the like. He proposes not to make that permanent, but to extend it for 5 years, and then also apply a minimum tax rule to that category of earnings as well. Income that meets the definition of qualified banking financing income under Section 954H or the comparable insurance rules would qualify for the exception from Subpart F as long as it's taxed at a rate at least equal to 50% of the U.S. rate. So again, 12.5% rate under the proposal. A couple of additional provisions, including making the look-through rule in Section 954C6 permanent. And then, as I mentioned, he would add a new category of income, foreign-based company intangible income. And the name is a little misleading because, in effect, this category of income is really a residual category of income, the income that's not actually defined as Subpart F under the rules that we just talked about briefly. It's intended to work in parallel with a proposal to reduce the U.S. tax rate on domestic corporations that earn income from the exploitation of foreign intangibles. So again, reflecting a favorable rate for certain intangible income, a question that Professor Rosenblum had asked about earlier as well. So the domestic favorable rate for royalties earned domestically is sort of reflected in this 60% high tax kick out in effect for income that's foreign-based company intangibles income. There's a formula here that describes what that income is, but is effectively a residual class of income that's not otherwise caught by the Subpart F rules. And again, if taxed at a 60% rate, would be excluded. So also he includes a provision that is designed to disallow interest expense in certain cases. The way it works is it works sort of similar to Section 163J, which applies more in the inbound context, and it's simply a provision that would disallow a certain amount of net interest expense. So it's a net interest expense item if a U.S. company that's part of a worldwide affiliated group, as defined in the proposal, basically a U.S. company with CFC subsidiaries. It would disallow a certain portion of that interest expense of that company if it has a domestic debt equity ratio that exceeds a worldwide debt equity ratio for the group, and the net interest expense exceeds a certain threshold, which in this case would be 40% of adjusted taxable income. And then lastly, just as you would expect, if you're going to an exemption regime, you would end up repealing the Section 902 deemed paid credit, and the proposal makes a variety of other recommendations related to the foreign tax credit, sort of emphasizing that it has at least a lesser role in this system than it does under current law. So a few of the changes are sort of outlined on this slide. But with that, I think those are the key features of the proposal. And now I think we're going to turn it over to Manal, who's going to talk about the administration's proposals, and you'll see some similarities, but of course some big differences as well.
So the administration, we obviously don't have the level of detail that we have in the Camp proposal, which includes legislative language and gets down to the real application, implementation pieces. But we have a fair amount of information, and the themes are pretty common, I mean strikingly common. The administration, the president put out a framework for reform in 2012 that began to outline the concept of reform that the administration had envisioned. And in that 2012 framework, the administration introduced the concept of a minimum tax for the first time on offshore earnings. At the time that was released, it wasn't crystal clear how the administration intended that tax to apply, whether that was an add-on to the existing rules for deferral, and somehow there was still a tax on repatriation, but adjusted at the time for the minimum tax, or whether it eliminated repatriation taxes altogether. The 2016 budget sort of clarified that issue and made the minimum tax really a substitute or part of a package that was a complete substitute for our current rules on deferral and the tax on repatriation. So in general, in the budget, the administration overall called on Congress to begin work on business tax reform that achieved 5 goals. First, cutting the corporate tax rate, paid for by structural reforms and eliminating loopholes and subsidies, strengthening American manufacturing and innovation, and I think Mark addressed that in his address, strengthening the international tax system, which is what we're focusing on, simplifying and cutting tax for small business, and avoiding adding to the deficit. So revenue neutral, and in terms of the administration's proposal, it's revenue neutral from a business tax perspective. It doesn't include individual taxes, but is broader than just corporation tax. Again, they said the policies needed to be part of a revenue neutral business tax reform, and it included a transition tax, this one-time 14% transition tax. So the FY16 budget that ends up being a mix of new and old proposals, and they combine, I think I skipped a slide here, nope, okay. So they do combine they keep some of the old proposals, which were introduced, many of them introduced in the FY15 budget, but also add these new concepts, including the minimum tax, the 14% repatriation. In terms of numbers, the transition tax, the one-time tax on repatriated earnings, is slated to earn around $269 billion in the 10-year budget window, whereas the other international tax proposals around $238 billion. Notably, the minimum tax proposal is a significant, about $206 billion of that whole $238 billion. The general outlines of the concept of the minimum tax in the budget is to impose a per country tax of about 19% or of 19% on the foreign earnings of a U.S. corporation, on the active foreign earnings of the U.S. corporation, so non-subpart F earnings. And it was intended to apply not only to the earnings of CFCs, but to the earnings of branches, so directly earned foreign source income of the branches of U.S. corporations as well. And again, it was effective as of December 31, 2015, and was intended to be about $206 billion, so a significant portion of the international provisions. So what is this minimum tax? I think viewed if you step back and look what it does, effectively what the proposal, the administration proposals, divides up offshore income into three buckets. A category of income that's completely exempt from U.S. tax, a category of income that, and you could argue that's a sort of a pure territorial exemption approach. There's a category of income that's subject to current U.S. tax at the current corporate rate, so that would be a pure worldwide approach. And then this middle category of income that is currently taxed, but taxed at a lower rate than domestic earnings. So in terms of, well, what is the bucket that is exempt? And here's where you start seeing some of the common strands with CAMP. I would say that the differences is in how broad each of these categories are in CAMP versus the administration, but the concepts are the same. In the administration's proposal, the category of income that would be exempt includes two categories. So one or two types of income. One would be non-subpart F income that is subject to a foreign effective tax rate of 22.5% or more. And then a second type of income that's also non-subpart F income, but equal to what is referred to as the risk-free return on corporate equity. So effectively what they're looking at are assets of the corporation that generate active income, so non-foreign personal holding company income, and they're looking to the risk-free return on that, and to the extent, however that's measured, the risk-free return on that, those assets would be completely exempt from U.S. taxation. I think Mark referred to that as they use the hotel example where you've got an asset and it's not movable and there's exemption. So that's the category of exempt income. On the other side of the spectrum, you have subpart F income. So as we know it today with some adjustments proposed in the budget that would broaden the category of subpart F income. And that income would be subject to tax currently at whatever the corporate rate is. And the administration's budget proposes a 28% corporate rate, so at 28%. So then in the middle, you have this other category of income, active income, that would be subject to a minimum tax. And that category would include any income that wasn't in the other two categories, so it's neither exempt nor subpart F income. And that income would be taxed at a current rate equal to 19% minus 85% of whatever the foreign effective tax rate was. So the 22 I mentioned in the exempt income, that is derived from that formula. The minimum tax is equal to 19% minus 85% of the foreign effective tax rate, but not below zero. So if you multiply 85% times 22.5%, you would get around 19, and that's why you get zero exemption on that income. But that effectively is the way it operates. And in terms of getting to determining your foreign effective tax rate, again, you look at it per country. It's a 60-month analysis. So you look at it over a 60-month period of time, and you ignore check-the-box entities. So you look at income as if it were in that jurisdiction without regard to checked entities. So you're looking at that taxation and determining the tax rate on a base that includes income without regard to checking U.S. check-the-box or 954C6. The effective tax rate is also looked at by neutralizing the effects of hybrids. So again, it's bringing in some of the BEPS concepts. If there's a hybrid where you have a deduction, no inclusion, for purposes of determining the base on which you're determining what your revenue is and your offshore earnings and your effective tax rate, you ignore that deduction if there's no inclusion in the hybrid payment. So just looking at it in comparison to CAMP, you say, okay, well, I've got a category of income that's exempt. I've got a category of income that's subject to a minimum tax. The difference is that in CAMP's minimum tax, the rate of the minimum tax is different and varies depending on the category of income. Here, it's 19%. It's higher. There, depending on the category, it's 12.5. In certain
12.5 or 15.
Or 15.
Yes.
The administration has said that the numbers that they've used to come up with this actually are less relevant than the concepts. So the math has to add up, but they view the rates as dials to get to an overall revenue neutral answer. So in terms of common ground, the discussion around rate is really, can you get to neutrality with respect to how you pay for the reduction in the overall corporate rate and having the overall thing be reformed. So the debate will be about what categories should or shouldn't be exempt, what's mobile and what isn't, and whether you can get the math to work at the end of the day when you talk just about international. In addition to those three buckets, kind of creating sort of this new structure for income, you have sort of conforming amendments to the Subpart F rules that, again, you see some of the similarities. You've got the high tax exception being made mandatory, just as in CAMP. There's repeal of Section 956 on taxation of investments in U.S. property, and 959 because sort of you've eliminated the need for those once you've gone to the structure that doesn't tax income on repatriation. In addition, you have conforming modifications to Section 1248 with respect to sale of CFC stocks, CFC stock attributable to undistributed earnings. Again, you've taken care of that because the income has either been exempt, taxed under minimum tax, or already taxed under Subpart F. And then, in addition, to create parity with respect to the built-in gain of assets of a CFC, there is an adjustment so that the gain attributable to the unrealized gain in those CFC assets will be taxed in the same manner as if the future earnings of those assets would have produced. So again, you apply the same concepts of the minimum tax depending on the character of that income. With respect to the foreign tax credit, because the minimum tax determination or the taxation of offshore earnings would be determined on a per-country basis, there is a rule that would prevent cross-crediting of high tax earnings against low tax earnings or earnings that would have been exempt from tax on high tax earnings against U.S. tax on earnings that would have been taxed immediately. And similarly, with respect to interest expense deductions, there's a limitation on the deduction of interest expense. So if its interest is allocable to income that's subject to the minimum tax, the deduction for that interest would be limited to the minimum tax amount. It's only deductible up to the amount of that tax. And any interest that would be allocable to exempt income would not be eligible for deduction. So again, a matching of interest expenses to the rate of income to which it's allocable. With respect to the transition tax, both CAMP and the administration have a transition. You've moved from a system where you've got a worldwide tax system and you've now got a system that either exempts income or taxes it currently. And what do you do with all those earnings that are offshore that haven't been repatriated and were supposed to be taxed upon repatriation? So in the case of the administration's proposal, it's a one-time tax at 14%. Again, a dialable number, the administration has said. It was what was used to make the math work, but a one-time tax paid over 5 years on those earnings. CAMP has the two-tier repatriation system depending on the character of the earnings, so slightly different approach, same concept.
But both significantly lower rates, yes.
Yes. Much lower than on the transition. So that's the headline news from the administration's proposal, and it really does flesh out a framework, the framework that they had originally proposed in more detail, and really more detail than most budgets usually go into. Green books usually are fairly bare bones. We've gotten a lot more window into what they're thinking, and we see that clarity. There's a number of other new proposals in the budget, including the permanent extension of active financing, which actually I think CAMP only did 5 years. This is a permanent extension, as well as the permanent extension of 954C6 look-through, with the reasons being that the understanding is the minimum tax takes care of any concerns associated with that kind of income, and so those can be permanent. So that's a simplification. They do some tightening of or concerns about what are referred to as Subpart F loopholes and technical runarounds or concerns about the way in which Subpart F is used, so dealing with the 30-day rule for qualifying as a CFC and the constructive ownership rules. And they also accelerate the availability of the worldwide affiliated group election for allocating interest. So interest is proposed. We have a law passed effectively to allocate interest expense on a worldwide basis, but the effective date of that law keeps generating income because it keeps getting delayed to make more money. And under current law, it's delayed until tax years after December 31st, 2020. The budget would move that forward to 2015 so that it matches up the approach to taxing offshore earnings with the allocation of interest expense and avoid the distortion that can create. And then there's the modified version of the inversion proposal. The budget also includes a lot of the proposals, many of which have been around for a while, but some new ones that were introduced in the last year's budget, most notably the ones that are echoing some of the BEPS concerns. And again, Deputy Assistant Secretary Mazur indicated that a lot of those budget proposals were informed by the work that was being done at the OECD with respect to BEPS. And the ones that stand out in that regard and are repeat from last year include the new category of Subpart F income with respect to digital income. The expansion of Subpart F was more of a U.S. concern, but echoes some of the concerns that were made are being addressed at the OECD with respect to CFC income and manufacturing services. But certainly the proposals to deal with hybrids, the denial of deductions with respect to certain hybrid payments are very much echo action item 2 within the BEPS action plan regarding neutralizing the effects of hybrids. So we're seeing that included here as well. And then in addition, you have the cap, the limitation on interest expense, which is being discussed in the BEPS action plan, though it's unlikely to see consensus, but seems to be likely to be part of any reform proposal in the U.S., which is a cap on interest expense that in this case, in the administration's budget proposal, would be a cap based on worldwide debt. The rest of the proposals, again, have been around for a while, and then there's some proposals that have been eliminated, and they've been eliminated because once you adopt this minimum tax approach, you get rid of the tax on repatriated earnings that you no longer need them. So the deferral of deductions of interest expense related to deferred income is no longer necessary because you don't have deferred income anymore, and that proposal has been substituted with the limitation on deductions depending on whether it's allocable to income subject to the minimum tax or to exempt income. The foreign tax credit, the very complicated proposal to determine the foreign tax credit on the basis of pooling is no longer necessary because of the per country approach to the minimum tax as well as the credit. And then the last one, taxation of excess returns associated with transfers of intangible income, again becomes superfluous once you have a minimum tax and you tax income either currently or you exempt it or subject it to a minimum tax. So those are the proposals. There's more in common other than there are differences, and the differences really end up being on, in my view, I mean, and a lot of people will debate that, but if you look at the differences, they tend to be on the dialing of the numbers or on the scope of what's worrisome income and what's not. There are differences in things like the taxation of royalties, with CAMP having a favored tax, sort of a patent box type or knowledge box approach to intangible income, and notably the administration's proposal taxing royalty income at full U.S. rates, not even the minimum tax rates, which is an interesting choice because it does mean that if intangibles are in a CFC and the royalties are received by the CFC, that would receive the minimum tax rate, assuming it's active. But if the royalties are received directly in the U.S., they'd be subject to the higher corporate rate, and it does create, potentially an incentive to continue to move that intangible offshore to get the favored rate on the royalty, and CAMP addresses that through a favored rate on royalties.
That's right.
So those kinds of things I think will be debated in the discussion and are actually very relevant to some of the issues that are going on and broader reform considerations about behavior. So with that and with Mark's positive attitude, do you think it's possible?
Anything's possible.
Yeah.
So I guess it falls on me at the end of this to explain in 10 or 15 minutes, given either the broken or at least the damaged state of the tax system, why we haven't done anything about tax reform, or at least try to explain when that might happen sometime in the foreseeable future. And I was remembering the last time I spoke at this conference was about 4 or 5 years ago, and one of the subjects was tax reform. And I boldly predicted at that conference that nothing was going to happen in the foreseeable future on tax reform. So I'll at least take credit on being right that time. Whether that prevails again, we'll see. So we're going to move from tax policy to tax politics, because obviously it's the tax politics that are gumming up the works. And sort of the simplistic view is of the uninitiated, which we see here from the Washington Post, definitely the uninitiated, is the tax reform shouldn't really be that hard. You just close some loopholes and lower the rates. Why shouldn't we do it right away? The more astute political view was expressed by the Speaker of the House, knowing what the problems are, recognizing the political difficulties and trying to do it. He famously said blah, 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 blah when someone asked him about tax reform and why it wasn't getting done. Very eloquently spoken. Both the Camp Plan and the administration's proposal for international reform and the Baucus proposal, to the extent we won't bring that in too, are all in the context of more comprehensive tax reform, either comprehensive individual and corporate reform, or in the administration's case, corporate reform alone or business reform alone. And the common element in these proposals generally is that you eliminate corporate tax expenditures or preferences, as the economists would call them, and you use the revenue that you save from doing that to lower the rates. And there are a number of proposals out there. They've been out there for years. I'm unfortunately old enough to have been around for the '86 Act. It was only about 2 or 3 years after the '86 Act that we started talking about tax reform again. There are any number of proposals. Some of the major variations we've listed here, things like adding a VAT to reduce the corporate rate, or taxing capital gains as ordinary income. You see these in a lot of the proposals. But the main elements are eliminating expenditures and lowering the rates. This is sort of I forget how many, what do we have here, top 7 reasons why we don't get reform. You could make it top 10 if you count some of the sub-bullets. But that's what I thought I'd kind of run through quickly. And most of these are the same as they were 4 or 5 years ago. Most of these are sort of universal problems with trying to do tax reform. The first one that I've listed here, I think, is more of a problem now than it was in the past, and that's the lack of agreement about revenue neutrality. Should we raise revenue with reform, or should it be revenue neutral? Should all the revenue that's saved by eliminating tax preferences and doing anything else you're going to do be used just to lower rates? And the reason that's a bigger problem today is that we now have, after the Budget Control Act of 2011, we've got caps on spending going forward, caps that are limiting the amount of revenue that's available to be spent by the government on the one hand, and on the other hand, a deficit that's coming down this year, will come down a little bit more next year, but then starts heading up again. And if you think that there are things that need to be done that require spending going forward, the last thing you want to do is give up the relatively easier money, the revenue that can be gained by eliminating tax expenditures and spending it all on reducing the rates, when you know politically that raising rates is about the most difficult thing to do politically. So there's a real difference of opinion about what to do. This is where the partisan politics really plays a major role. To the extent that that's gumming up the works, other than people just not talking to each other, getting along, this is where partisan politics really comes into it. Inevitably, if you do pure tax reform, revenue neutral tax reform, what you're doing at the end of the day is you're redistributing tax burden. And that means that a number of taxpayers are going to see their taxes go up rather than go down in reform. And it's not surprising that those who see taxes increase in tax reform tend not to like it. It becomes not their favorite thing to do. And it's even worse politically than that, because what happens inevitably when a proposal is put on the table that has tax expenditures cut or eliminated in it is that the taxpayers who enjoy those benefits, seeing the difficulty in doing comprehensive reform, realizing that it may not happen, begin to worry about something else. And that's that tax reform won't happen, but now their fully drafted, fully scored revenue-raising provision is now sitting out there for someone to pick off when revenue is needed. So that will start, even though they may be winners under the tax reform proposal as a whole, will nevertheless come out objecting vehemently to the particular proposal that affects them. And we saw that, for instance, in the Camp proposal, sort of in spades, when he included in his proposal, sort of rebalance the books a little bit, a tax on bank assets. The banks were financial services entities in general were big winners under the Camp proposal because they didn't lose things like accelerated cost recovery and the manufacturing deduction. So they enjoyed the rate reduction without the pain, so he wanted to add a little pain to sort of balance things out a little bit, and the banks came out vehemently against that bank tax that he'd included. So the lobbying is even more intense than you would expect just from the losers. Even the winners tend not to like tax reform, or at least enough elements of it that they gum up the works. Thirdly, the revenue that can be gained by eliminating tax preferences is not nearly as great as you would think, given the talk about 25% rates and such. And that's particularly true if you look at the revenue gained on a permanent basis rather than on a temporary basis. And what I mean by that is if you eliminate the biggest corporate tax preference that's on the chopping block, potentially in tax reform, is accelerated cost recovery, raises whatever it is, $500 or $600 billion over 10 years. The permanent revenue is probably half of that, because accelerated cost recovery is, of course, a timing provision. So it only raises permanent revenue to the extent there are increases in the capital stock going forward. So if you look at what revenue is raised on a permanent basis, according to a Congressional Research Service report last year or the year before, you could really only get the corporate rate down to about 31.5% just by eliminating preferences, if you leave alone the deferred foreign earnings that are allowed under the current system. So the revenue is not there to do the kind of rate reduction that's generally out there. The direction of that kind of reform on the corporate side, eliminating things like accelerated cost recovery and the manufacturing deduction and last in, first out accounting for inventory, heavily affect the U.S. manufacturing sector. So it's not hard to identify the loser here. The loser is U.S. manufacturing. The winners in that kind of system, if you don't do anything about international, are financial services, 4 of the top 5 categories, if you look at it by industry codes, and multinational corporations who aren't losing anything just by elimination of preferences like accelerated cost recovery. So that's not a particularly politically appealing direction of reform, to be increasing taxes on U.S. manufacturing and using it to pay for financial services rate reduction, although the banks would probably disagree with that. The economic benefits, to the extent that people look at that politically, and they do to some extent, I think are more questionable than you would believe from the rhetoric. And all you have to do to see that is to look at the Joint Tax Committee macroeconomic analysis of the Camp plan. If you look behind the top line of the analysis of that proposal, what you see is on the second line when they talk about the effect on growth going forward under the Camp plan, Because of the nature of the preferences that he's eliminating, which are things like accelerated cost recovery, what you're doing in effect by eliminating those is you're actually increasing taxes on savings and investment, which is what those represent, and using that for a rate cut, which is effectively a change in taxation of consumption, a reduction in taxation of using up of current assets. So the long-term growth effect, according to the Joint Committee, is somewhere between 0 and minus 6%. So it actually has potentially a negative effect on growth. And I also mentioned here, we talk about someone was talking earlier today about what happened after the '86 Act when we did cut the corporate rate substantially from 46% down to 34%. And what did happen in the rest of the world is the rest of the world followed suit and reduced their rate even more than we did. To attempt to gain some sort of competitive advantage by reducing rates when the U.S. economy still represents 20% of world GDP becomes something of a problem, because the world invariably will react to the largest player. Doesn't necessarily have to react when Ireland cuts its rate by 5 or 10%, but when the U.S. does it, the rest of the world reacts. I guess one way to look at it is we're probably we're the turtle in the race to the bottom if we ever try to do that. So the competitive advantage that could be gained may not be there. Surprisingly, given how much politicians talk about tax reform, and every politician has to be for tax reform, the public, is sort of for it, but it's not a huge issue. And if you look at the polling, you see that in spades. There was a Pew survey of the top issues facing the country a couple of years ago, in 2012. Out of the 24 issues listed, the public ranked tax reform 16th, not particularly high. There was also a Gallup poll done on issues facing the nation, and the percentage of the population that thinks the tax reform is the most important issue was 1%. There are lots of things people consider more important, and people were it was mentioned earlier today. I mean, it really is not at the top of the public's mind either, which reduces it somewhat in the minds of politicians. And then lastly, let me talk about the potential for corporate-only reform, which is the direction things seem to be going currently. And there are reasons to be looking at that, obviously. One of the biggest holes in the system, as we've been hearing all day today, are the problems with the taxation of foreign earnings under the current system. There are big dislocations there. I think maybe the biggest one that people have sort of talked around, but the effective tax rate on U.S. tax rate on domestic earnings is somewhere about 27 or 28%. Again, according to another Congressional Research Service report, the effective tax rate on foreign earnings was 15.6% back in 2006. There's a huge differential in the effective tax rates. That being said, a major concern of politicians when you start talking about corporate-only reform, however much sense that may make from a policy standpoint, the rank-and-file member of Congress is worried about how to explain to constituents when they go back to their district why we reformed the corporate rate, reformed the corporate tax and reduced the rate, but didn't do anything for individuals. What did you do for me? You fixed their problem, you didn't fix any of my problems. That is a significant barrier, and we hear that right up to the people who actually understand what the problems are in the corporate area and in the international area. So there are a lot of reasons why we don't do tax reform very often, and we haven't done it since 1986 in any significant way. And I think the prospects, as always, are kind of dim. If I see some hope in any of this, it's that, as we've been talking about here, there seems to be, at least in the international area, some convergence on the framework for doing that, for addressing the international tax issues. and some outside reasons to do it. The outside reasons and the kind of things that push this through are things like the publicity that surrounds corporate inversions, which look pretty ugly to the public, and the potential need for revenue that you can raise by doing that kind of international reform. And we're going to see that coming up very shortly in connection with the Highway Trust Fund, which needs a great deal of money just to stay solvent, about $16 billion a year. But that's just sort of the tip of the iceberg in terms of the infrastructure spending that Congress is looking at as needed in the future, which is in probably the hundreds of billions of dollars, because we have a highway and utility system that's falling apart. So looking at things like international reform that raises revenue may be something that Congress does actually look at more seriously. I'm not sure it's going to happen this year. I'm not as optimistic as Mark Mazur was, but that's what he's looking at, I think, at the moment as a potential vehicle for what the administration's proposing.
Great. Thank you. Do we have questions or no? Okay. Where's Larry?
I don't know.
Oh, there he is.
There he is.
Let's see.
Well, it looks like there are no questions. Thank you, Manal, Tom, and Bob for that presentation. We've covered a lot of ground today and hope that you now have a more informed view as to whether or not the U.S. international tax system is really broken or perhaps just in a state of disrepair. In order as a reminder for claiming CPE or CLE credits, all you need to do is submit an evaluation form, and for CLE, you need to just drop your name tag in the basket on the way out, designated for CLE credits. Please join me in thanking our distinguished speakers and our participants for a wonderful program today. Meeting adjourned. Thank you.